Hi, this is part 1 to an introduction to technical analysis. If you've heard of trading or technical analysis but are unsure of what it is, but want to learn more, then this is a video for you. By the end, you'll have gained enough knowledge to have a basic understanding of charts, as well as to generate some basic trade ideas. There's two types of analysis, fundamental and technical. You're probably more familiar with fundamental. It asks questions like, how's the global economy doing? Is the stock over or undervalued? Is the company facing competition? What is news relating to the company? What are interest rates? These are all questions that a fundamental analyst asks. Technical analysis ignores these. It focuses solely on what the charts tell you. It focuses on price action. Price action is the movement of prices and understanding what they're telling you. Often day traders, or traders that close their positions out by the end of the day, they use technical analysis to generate their trades. Market psychology is held within price action. Therefore, understanding price action can tell you what traders are thinking, and where they're getting in and out, and how you should trade accordingly. This video will focus on things like support and resistance, trend lines, and moving averages. And these are things that all profitable traders have a strong understanding of. Indicators will be in part 2. They won't be discussed in this video. So to start, we'll talk about the types of charts. And you're probably more familiar with a line chart. If you look at TV or pull up a stock on your phone, then you'll probably see a line chart. And the line chart only shows the closes. So if we have a close yesterday, and then today happens, a new data point is plotted, and the close of today is here. Another day happens, a new data point is plotted, and it's plotted here. A better type of chart is a candlestick chart, and this is one that most traders use. It shows more information for the time period. So a bullish candlestick chart is one where the price went up over that time period. It opens, and at the top of the square is where it closes. Green is bullish, and bullish meant it went up over that bar. These tails represent where prices went beyond this range. So this line chart represents the same information as this bullish candlestick chart. The prices opened, they went down, they went up, and they closed higher than where they opened. And this down move is what created this tail on the bottom. And this up move up here is what created this tail on top. And this close here above this open is what caused this green bullish candlestick. And the opposite would be true for a bearish candlestick. So these terms, bullish means it's going up, and bearish means it's going down. An OHLC chart shows the same information as a candlestick chart, but a candlestick is easier to get the information from. It's more visually appealing. So let's go over that one more time. Candlestick bar, the open for a bullish bar, a green bar, is at the bottom, and the top of the square is where it closes. So if it opened today at this price and it closed higher at this price, then it would cause a green bar because it went up. And these tails are where prices went beyond this range. So there are other types of, or there are many types of bars you can use. For example, a 5-minute bar. So we opened here, prices shot up through the day, or through the 5 minutes, and then came back and closed here. And then you could look at this same time period over just 1-minute bars. So we opened, we shot up, and went down and closed. So you could use any different time frame to look at in your studies. So to be clear, these 1-minute bars are representing the same information that this 5-minute bar is using. There are two types of markets, a trending market and a trading range. Trends mean the price is only going up in one direction. and it's better to only enter in the direction of the trend. Trends have higher highs and higher lows in a bull trend. In a bear trend, it has lower lows and lower highs. A trading range is the opposite. It's where prices don't have a clear direction. Prices keep reversing. There's also lots of overlap in a trading range. So let's see a trend. This is a bear trend, bear meaning it gets going down, and it has lower highs, lower high, lower high, lower high, and lower lows. A low, lower low, lower low. And this is a bull trend, meaning it's going up. So we have a high, a higher high, a higher high, a higher low, a higher low, a higher low. And this is a trading range. Lots of overlap. No clear direction. We're not really sure where it's going. And many tails. Lots of uncertainty in a trading range. And the market can be in both. If you were looking at this, it's clearly a trend down here. We have lower highs and lower lows. But if you were to expand out, you'd see we're just within all this other range of these bars. So it's important to know where you are if you're in a trend or in a trading range. But if you zoomed out enough, you would always see that you're within both. Now, breakouts and pullbacks. A breakout is when you have a high, and then it breaks out above it. And then a pullback is when the price moves back some. So we see we have a high here, and prices break out. A high here, and it breaks out. And a pullback is when prices pull back. Another pullback here. Pullbacks create entries. The trend is up. We have a pullback and a better price to get in. Notice how after each pullback and a bullish bar, the trend continues. So we have a pullback, a bullish bar, the trend goes up. Pullback, bullish bar, trend goes up. Larger pullback, but pullback, and the trend goes up. And this bullish bar is called the signal bar, and this is signaling you that there may be a trade for you to take. This is a signal bar, this is the signal bar, this is a signal bar. And the bar after it is an entry bar, and this is the bar you enter on. So if you were to take this trade, you would place an order to get in above this bar, and then this entry bar is where you would actually be filled and you would get in your position. And you would be in a long position, which means you want it to go up. And if you wanted it to go down, you would call it a short position. Sometimes you have a second entry, which means that the probability is higher of your trade working. So we have a pullback, and then a first entry, the first signal bar. And within the same, when you get a second pullback, and you get a second entry. And this is higher probability. Support and resistance is also important for traders. Looks at prior lows and prior highs. So notice we have a high here and a small pullback, and then it broke out. And then what did it do? You see this tail came down and tested this high, and it continued up. Then we have a high here. We broke out above it. And what happened when it came back? It acted as support. So we have support here. So we have a high. It broke out above it and became support. We have a high here. Broke out above it. Became support here and over here. We also have double tops and double bottoms. So this here would be a double bottom because we bottomed once, then came back to it and bottomed twice. And we also have a double top. We have a high here and another high here at the same level. And we have double bottoms and double tops, they often reverse. So we have a double top and a reverse down. We have a double bottom on a somewhat larger time frame. double bottom and reverse up. And then here's our double top. Trend lines and channels also can act as support and resistance. Look at these lows. You can draw a line between them, and they keep reacting at this level, at this diagonal level, and this trend line acts as support the way up. Now, if you were to draw a parallel line up here on these highs, well, then now you have a channel, and you see that these highs, this channel line is acting as resistance up here. And two trend lines create a channel, and traders will trade within this channel. We have a low and a higher low, and so you can draw your trend line, and you can make a parallel for above. And then now this trend line, this channel line, will act as resistance up here. So moving averages. A moving average is you take the average close of the last so many bars, and that will give you a price where the average price should be. A simple moving average is where you simply just take the average of the last so many bars. So example, the 20 simple moving average, we would take the average of the last 20 bars closes, and then that would give you what you should expect as an average price. And an exponential moving average just means the bars more recent are more important for this average. They have a larger weight. So let's see, this is the 20 EMA, the 20 exponential moving average. So it's taking the last 20 bars closes and it's adding them up, and it's finding the average. So it's taking this close, this close, this close, and so on, and it's just finding the average of them. And since it's an exponential moving average, that means the more recent bars are more influential on what the price is. And this is a 200 EMA, so a much larger time frame moving average. And you can see it's much flatter and more resistant to change, because each bar influences the total change less. And you can see how it acts as support. Anytime prices come near it, it bounces off. This is also how you can tell you're in a trend, that prices just continue to bounce off of the EMA the whole way up. And you see how the 200 exponential moving average acted as resistance here, and then it broke out, acted as support here, and acted as support again. Now we can talk about the Fibonacci sequence and the Fibonacci retracements. So really, the Fibonacci sequence is basic math. You add the previous number to the current number in the sequence, and you get the next number. So we have a 1 as the previous number and a 2 as the current. So you add them together and you get a 3. Now the 3 is the current number, and you add the previous number to it and you get a 5. And you can keep doing this in the sequence. And when you take a ratio of these numbers, you can get Fibonacci retracements, or Fibonacci numbers. So let's say we took 13 and 21. 21, add the previous number, 13, and you get 34. We can take ratios of these numbers. 13 divided by 34 gives you 38.2%. And 21 divided by 34 gives you 61.8%. And the math behind this really isn't important. It's just understanding that traders do respect these numbers in trading. So let's look. So we have a swing down here. You can call it a swing, a large move, or you can call it a leg. So we have a swing down. And now how much do we think it's going to go back? How much do you think it's going to retrace? Well, one of our numbers was the 38.2%. So we're likely to retrace 38.2% of this move. So let's see, we had a swing down. We draw our Fibonacci retracement in from this high to this low, and it retraces back 38.2%. It came back to this level. And the 61.8 was also a number we had. However, it didn't quite get there. 50% isn't a Fibonacci number, but it's very respected by traders because it's in the middle of a move. and often prices will find support and resistance there. We also have measured moves. A leg 1 is equal to a leg 2. So we have a leg up, and a pullback, and a leg 2. And the second leg is often the same distance as the first leg. And we see if we had drawn a line here, then this second leg would have been about the same distance as the first, and this third leg down would have been about the same distance as the first here. So let's put it all together. Here we have a chart with our retracement drawn in. We also have our moving averages already drawn in. So we have our 20 EMA and we have our 200 EMA. And remember, the exponential moving averages act as support and resistance as well. We can also add in trend lines we talked about. So from this high to these highs, let me see, it reacted here. And this caused confluence. Confluence means multiple things happening in one area. So we have the 38.2 retracement and the trend line meeting this area, making it more likely that there will be the prices will change here. The prices will respect this level and it will act as resistance. We can also draw a trend line from the very highs here, and prices respected it there. It acted as resistance. And we also had confluence with the 200 EMA, so that the 200 EMA made it more likely that prices would stop there. As well, we had this touched the 50% line, and it was around the area of the 50%, and increased the odds of there being of this area acting as resistance. We can also draw on our leg 1, leg 2 moves. We have leg 1 up, pull back, and we can expect the second leg to be the same distance as the first, and look where it went, right in with the other levels. So this is the end of part 1. Part 2 will have talks about indicators and a brief explanation of each. It'll talk about things like Bollinger Bands, RSI, volume, and these aren't too important for trading, but some traders don't use them at all, but others do. So, and it's good to be knowledgeable and to have some experience with them. Alright, thank you.